If you've elected S Corp status for your business or you're thinking about it, one question probably came up almost immediately. How much should I pay myself? And it's unfortunately not a simple answer, which is probably why so many solopreneurs either get it wrong or just avoid thinking about it altogether. But getting this wrong can cost you thousands of dollars in back taxes and penalties. So it's worth understanding. Hey y'all, I'm Nikita from Collective, and today we're going to break down how the S Corp reasonable salary works, how the IRS decides if yours is reasonable, and how to figure out a number that actually makes sense for your business. But let me start by why this even matters. When you're a solo S Corp owner, you wear two hats. You're an employee of your own business, and you're also the owner. And your reasonable salary is intended to cover your role as the employee. Now, a quick refresh. The savings potential of an S Corp election comes from the way you split your business income between salary, this is you as an employee, and the leftover profit, this is you as the business owner. Without an S Corp election, your entire profit is subject to the 15.3% self-employment tax. But with an S Corp election, you only pay that 15% on your reasonable salary. The win? A portion of your income now bypasses self-employment tax, leading to a big savings potential. So many entrepreneurs think that they'll just pay themselves a low salary and reduce their tax bill further. But here's the catch. The IRS requires that you pay yourself a reasonable salary if you also take any distributions. If you try to game the system by paying yourself a very low salary or skipping it entirely, you're putting a target on your back for a reassessed tax bill and your S Corp election being revoked. So what does reasonable actually mean? The IRS doesn't give you a specific number or even a specific formula. What they look at is whether your salary is comparable to what you'd have to pay someone else to do the same work. That's the basic standard. If you're a freelance photographer running an S Corp, your salary should be in the ballpark of what a photographer with your experience would earn in your region working for someone else. Building a documented foundation for your business could include the nature of the work you do, if you work full-time or part-time, where you live, and your seniority or experience in the role. None of these factors alone determines your salary, but the IRS looks at the full picture. The through line is what would a reasonable employer pay someone to do what you do. Now, I'm sure you just heard all of that and you're like, Nikita, but what number do I actually land on? And the good news is you don't necessarily need to land on one exact number. You're really trying to establish a reasonable range, and anywhere within that range can be defensible. So let's talk about how to build that range. The first thing you want to do is research market rates for your role as the service provider. Now, to be clear, I'm talking about the actual work you personally do in your business every day, not necessarily the title on your business card, but the actual job function. If you spend most of your time doing client work, look up what someone in that specific field earns. Sites like the Bureau of Labor Statistics, Glassdoor, LinkedIn, and industry-specific salary surveys are all useful here. You want to find a range that reflects your experience level, your location, and your industry. Once you have that market range, think about where within it you realistically fall. More experienced or established in your field, you might sit toward the higher end. Newer to the work or still in the earlier stages of your business, the middle or lower end of that range could be perfectly reasonable. The second thing to factor in is what your business actually earns, because your salary has to be something your business can afford. The IRS doesn't expect you to pay yourself a market salary if your business can't actually support it. If your business brought in, say, $60,000 in profit this year, your cash flow can't support a $120,000 market salary. Your salary should be reasonable relative to both market rates and your business's actual financial performance. An informal rule of thumb you'll hear is somewhere between 40 and 60% of your net profit as salary, often described as 60% salary, 40% distributions. This isn't a vetted IRS formula, but it can be a useful starting point for estimating your range. If your business nets $200,000, that puts your salary range roughly between $80,000 and $120,000. When that range also lines up with market rates, it could hold up better under scrutiny. The third thing to consider is whether you're the only person doing meaningful work in the business. If you have contractors or employees handling significant portions of the revenue generating work, that can affect the math. But if you're truly a business of one and everything that gets done by you, that needs to be reflected in your compensation. Once you've worked through all of that, you should have a reasonable range to work within. Where you land inside that range is up to you, but it's worth keeping both ends in mind. If your salary is on the higher end, you're still within your range, but you may give up some of the tax savings the S Corp structure is designed to create. And if you go too low, below what the market research supports, you risk the IRS viewing it as unreasonable, which can trigger reclassification of your distributions as wages, back payroll taxes, interest, and penalties. So the goal isn't to push to either extreme. It's to find a number that's genuinely defensible, reflects the work you do, and lets your business continue to operate and grow. Now let's talk about some common mistakes people make here, because it's worth talking about. The first is setting the salary once and never revisiting it. Your salary should evolve with your business. If your revenue grows significantly, your salary should probably grow too. If you keep your salary flat while your distributions balloon year after year, that pattern can attract IRS attention. Review your salary at least once a year and adjust as necessary, the same way annual compensation reviews happen in a normal job. The second mistake is conflating what you need to live on with what you should pay yourself. Those are two completely different questions. Your personal budget is not the right starting point for determining your S Corp salary. It's tempting to look at your monthly expenses, rent, groceries, car payment, and work backward from there to set the salary. But that instinct only makes sense when you've had a W-2 job because your paycheck was meant to cover your life. But as an S Corp owner, the structure is different. The profit your business generates is still entirely yours. But remember, you're receiving it in two parts instead of one: salary and distributions. Both flow to you and are yours to spend however you need. So try to think of your salary as the part that runs in the background. It keeps your S Corp compliant and ensures you're paying into Social Security and Medicare, which are benefits you may actually draw on someday. Your distributions cover the rest. Between the two, your total cash flow should remain the same. And that brings up another important point. S Corp elections don't make sense for everyone. If your profit is under a certain threshold, the potential savings from an S Corp may not outweigh the added administrative costs. Things like payroll processing, additional tax filings, and accounting fees. For collective members, the break-even point is usually around $60K of profit, where the savings potential is equal or more than the cost of collective. If you're not there yet, it could be worth staying a single-member LLC and reassessing an S election later. The third mistake is not running payroll properly. Once you set your salary, you need to actually pay it through payroll. That means setting up a real payroll system through a payroll software. This lets you easily withhold the right taxes, submit payroll tax deposits on time, and the software will automate and file the required quarterly and annual payroll tax returns. Some business owners set an S Corp salary and then just transfer money to themselves informally without running it through payroll. That's actually not running payroll. That's a distribution, and that does not meet the salary requirements of an S Corp election. The IRS expects to see a proper payroll trail. If you're not doing this correctly, you could face penalties, even if your salary amount itself is reasonable. Let's also talk briefly about timing, because this trips people up too. You can pay yourself a salary on whatever frequency makes sense for your business. Weekly, bi-weekly, monthly, but if you do, you have to be consistent. Erratic payments with no clear schedule can look like you're managing your salary reactively based on what's left over, rather than treating yourself like a real employee of the business. One approach some solopreneurs use, especially when income is unpredictable, is to pay themselves a conservative base salary throughout the year, often on a monthly cadence. Payroll software makes it easy to either skip or run off-cycle payrolls to account for unexpected or inconsistent income. So you have flexibility without sacrificing compliance. But can we zoom out a little, because your S Corp salary isn't just a tax decision. It affects your Social Security benefits down the road because those are based on your earned income. It also affects your maximum retirement contribution amounts, and it can have an impact on how lenders view your income if you ever apply for a mortgage or a loan. So when you're thinking about your salary, don't just think about what minimizes your tax bill this year. Think about the longer-term implications for your financial life. The sweet spot is a salary that's clearly reasonable, supported by market data, your business can comfortably afford, and leaves room for distributions that actually make the S Corp worth it. Finding that number takes a little research and ideally a conversation with a tax professional like Collective, who understands the S Corp structure. So let's recap. Pay yourself a reasonable salary based on market rates and what your business earns, and don't chase the minimum. Run payroll properly and consistently, and review your salary regularly as your business grows. And try to think beyond just this year's tax bill when making the decision. The most successful solopreneurs will do some research up front, establish a documented range, and choose a number within that range they feel comfortable standing behind. Ultimately, where you land is your call as the business owner. And there's real flexibility here. Most payroll software allows you to skip a payroll cycle or run an additional payroll throughout the year if your business circumstances change. So you can make adjustments. Just remember to avoid setting your salary so low that it raises red flags. The IRS determines your compensation was unreasonably low. They can reclassify your distributions as wages, which means back payroll taxes, interest, and penalties that can quietly erase years of savings. So do the work up front, choose a number you can defend, and let the structure do what it's designed to do. If you found this video helpful, be sure to give it a like and subscribe for more content built specifically for solopreneurs. We put out new videos all the time on business, taxes, structure, bookkeeping, all the fun stuff that comes with running a business of one. So I'll see y'all in the next one. Bye.